Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome to Money on Tap. My name is Seth Krussman.
And I'm Ben Brayshaw.
You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are so excited to have you along for the show today. We have a special guest, and that's Sean O'Hara, president of Pacer ETF Distributors. He's going to hop on board with us today. We're going to be talking about several different strategies, okay? What's going on in the market, history of markets, how is this important for you right now? We're going to build some context into this show and have some fun with Sean. And
I'm excited, Seth. I'm excited about the fact that they use metrics, that they're a tactical manager. We talk about tactical managers regularly. We really believe that tactical managers play a role in almost everyone's portfolio potentially in some way or some manner. Pacer has become a super fast-growing organic ETF. They've become a large player in the industry, run by Sean O'Hara and his partner, and they've got a lot of story to tell. They've got a lot of things going on that are of huge interest, and they've done really, really well through this turbulent market comparatively. And it is an ETF firm we use with some of our clients in some portion of their portfolio, and depending on the scenario. And I think this type of story is so relevant today for what we're dealing with and the concerns and fears that people have in the market, Seth. I mean, we've been interviewed on the radio. People have asking us questions. We get calls about, hey, what do you guys see? Just interest. I get calls from other financial planners. What are you guys doing? How are you guys looking at this stuff? And, you just can't have, everything in the wind. We talk about this all the time about having foundations in your portfolio and making sure you're well balanced. It's not just about diversification inside small, mid, and large cap assets or owning a little real estate here or things like that. It's really about having diversification in the type of assets you own. That's a whole nother infrastructure. And that's the three-dimensional side of planning that we do here at Brayshaw Financial, and we try to communicate over Money on Tap. Sean is often found speaking on Fox Business, CNBC, and other various news outlets, giving insight to the market in a lot of different ways, and we're excited to have him here today with us.
One of the things we want to talk to you about or ask you about is a little bit about your background. What's your experience in the industry? Kind of tell us, how do you get to be where you're at today?
I've been in the business about 35 years. My current partner is a guy by the name of Joe Thompson. I started working for Joe at a company called Planco in 1985. Planco was an independent national wholesaling operation, and ultimately we became the wholesaler for the Hartford for their annuities and their mutual funds and 401ks, and got to be such a big part of Hartford's overall business that they ultimately bought Planco. And so when that happened, I was running half the country out of Dallas, Texas, and I moved to Philadelphia, which is where Planco was based, and took over a big part of what Planco was doing. And I stayed there probably 6 or 7 years after the acquisition. So I've been in distribution my whole life, if you will, both on the annuity fund and 401k side. I ran distribution in Japan for a variable life company we had with the Hartford there. I ran a unit-linked investment bond business in the UK with the Hartford and a Canadian mutual fund company. And I just sort of got I wanted to sort of do something on my own, and just about that time, Joe's non-compete was running out, and so we decided initially we were going to essentially set up an independent wholesaling operation and try and find some folks who needed some help getting their product to the market. And the first company we found was an ETF company here in Philadelphia that was just getting ready to launch. It was called Revenue Shares. We actually changed the name. It wasn't Revenue Shares initially. It was called Tigers, which stood for 3 indexes for enhanced by revenue or something like that. We thought it was a dumb name, so we we changed our name because they weighted the S&P 500 by revenue. So it's revenue share. So we got them up and going. From there, we moved on to Royal Bank of Scotland and helped them sell their exchange traded note platform, which is where the core of our ETF business came from. They called us up one day and said, we're getting out of the ETN business. And we had spent a fair amount of time and effort and money building the business. And we loved the strategies that they had. And so we used that as our opportunity to become a full-blown manufacturer and distributor. So we had already had a lot of the infrastructure in place. And so we together, Joe and I, have been working, like I said, 35 years. It's more than 10 years now in the ETF business. But for ourselves, with our own ETF company, we'll have our 5th birthday in June of this year.
Sean, so you guys have 5 years coming up on your anniversary, which is probably that's a big number inside the ETF space. I think it'd be good for our audience to hear a little bit about the exciting growth you guys have seen organically. Can you share a little bit about that?
Yeah, I mean, we've been very fortunate. We got a fast start initially because of the RBS business. We got to move a little of their exchange traded note business to ETFs. And we have been growing pretty rapidly, doubling almost year after year after year. Last year, we didn't quite double, but I think we grew the size of our company by about 75% or 80%. We've even been fortunate this year in terms of net new flows. We've had about, almost about $500 million worth of net new money come in. Now, our AUM has taken a little bit of a hit here with the market, but we continue to be very fortunate in being able to attract new assets and to the ETFs that we make, and to become part of more and more financial advisors, day-to-day business, which we feel we have a lot of gratitude for that.
Yeah, I'm excited to get into some of that as well as we kind of really dive into what Pacer is and why you guys are so unique in the industry and why you're growing so fast. Can you share a little bit about how big you are in the ETF space, compared to when you started 5 years ago and had $0 today?
Well, yeah, I mean, so zero, we didn't exist. That's obvious. Right now, I think we're the 19th largest ETF issuer in the United States at a little bit, about $5.1 billion today.
Yeah, that's really impressive. And I know personally that I think you guys are the fastest growing ETF organically out there, if I have my facts correct on that.
Yeah, I mean, I think there's a lot of, there's a lot of big issuers that sort of brought their own assets to the table, like a JP Morgan who's, probably 30 or 40 billion dollars today and got there fairly quickly, but they bought a lot of their own assets. We don't have any of our own assets to bring. We continue to thrive and exist based on financial advisors allowing us to become a part of their clients' portfolios.
Yeah, and I'm really excited because there's a lot about having you on the show and why you're growing so fast that, our audience really would like to probably get some exposure to that, what makes Pacer different and so forth. So I want to ask you a little bit about how, and we're I'm speaking specifically probably more about the Trend Pilot series that you guys have. You want to share a little bit about, the investment style and the metrics you guys use inside the Trend Pilot?
Yeah, so Trend Pilot is a trend following strategy. We use the 200-day simple moving average primarily to gain access to an equity index. There's a version of it that tracks the S&P 500, one that tracks a mid-cap index, one that tracks the NASDAQ 100. There's a European version. There's an international version. There's now a high yield version, and then there's a fund-to-fund version. But essentially the way it works is that if whatever index that we're supposed to track is above its 200-day moving average, we own the index outright. And then when that index starts to fall below its 200-day moving average, we start to move the portfolio to T-bills. The whole idea is to just have the portfolio eventually, as the market falls, go to T-bills and stop going down. That we think has value in a portfolio. We know we're not going to get the top exactly right, and we know we're not going to get the bottom exactly right. But what we do know is that if you use a 200-day moving average, eventually, if the market falls, you're going to wind up in T-bills. And when we go through an environment like we're going through right now, where you wake up every day and it's market limit up or market limit down, having some part of your portfolio that's not exposed to this insanity in the market today seems to us to be a pretty good idea.
Yeah, no, absolutely. And I think that's really part of what people are looking for right now is, how do I curb, in a scenario where the stock market drops 35%? I mean, we watch this market fall, and then someone says, well, how do I just mitigate a little bit of that loss? And that's something that that Pacer can help you with. The tactical side of investing, Seth and I have talked about for years on this show, and trying to manage portfolios through that and weather storms like this. So tell me a little bit about, when you guys pulled out of the market, a little bit about when the 200-day moving average shifted this last session, in the last month or so.
It's an interesting question. Before I answer that question directly, one thing I want to say is that the beauty of an ETF wrapper is that you're able to rebalance ETFs without creating the nasty capital gains that everybody, worries about. And so sometimes when the market starts to go down, everybody has big profits in their positions, and they don't want to sell because they don't want to pay the tax. So that's one of the big advantages of Trend Pilot. But if you think about this current cycle, high yield went out first. This old adage on Wall Street that, the bond guys are smarter than the stock guys. So we exited high yield first, and then came mid cap, and then came international, and then eventually the large cap stuff sort of moved to the sidelines as well. It was the last to move, the large cap on the S&P 500. NASDAQ's actually still 50-50 today, but it sort of went in waves, if you will, and it was pretty rapid. They all sort of, kind of day after day after day, the portfolios were all moving to T-bills.
So how do you evaluate the quicker moves that we've seen lately, or versus historically?
Well, I mean, this is unprecedented. What's going on right now? It's never happened before. I guess. The thing about the statement "it's never happened before" is that it almost always will eventually happen, I guess. But when you look at the market over time, we do go through bear market and bull market cycles, and they don't tend to be as violent as this was. The last violent move down was 2018 at the end of the year, which was a pretty nasty correction. This one became a full-fledged bear market. But the decline was so fast. It was the fastest ever. I think it was 20 days to go into a full bear market mode. That's not normal. Normally, the trend changes over time. I think the reason that this particular cycle down was so abrupt and so violent, if you will, is it didn't start as an economic issue. It started as a medical issue that eventually has turned into an economic issue. And so I think that's why this one's fairly unique.
We are talking to Sean O'Hara, president of Pacer ETF Distributors. If you have questions about the discussion we're having right now, you can reach us at 855-226-8551 or info@yourmoneyontap.com.
If you think about it, Seth, we went to full-blown bear market in like 20 days. And then in the course of a week, we've now had a new bull market, if you measure it by percentages. And
right.
So that makes me a little suspect if you want to know the truth. The average bear market is like a year and a half to 2 years long. I don't think, 3 days worth of a bear market is enough to kind of wash out all the selling, perhaps.
So maybe there is something new here, a bear correction or a...
Yeah, it was like, I like to say it's sort of like an asteroid hit the planet, right? I mean, there's no planning for it. There was no reason for it, really. I mean, stocks were a little overvalued for sure and trading at 20 times earnings, but there was no, we had low unemployment, low interest rates, high labor participation rate. Corporate earnings were seemingly doing okay. It's just that we shut the entire world economy down, it seems like, in stages. And, it started with Italy shutting the whole country down. Then you had, here in the U.S., the NBA, then the NHL, then Major League Baseball had to follow. Then you had counties closing down, and then you got counties go to states, and it just happened so rapidly. And the cure to fight this virus currently is what's killing the economy and the stock market. It's the complete lack of economic activity that we've created as a result of keeping everybody socially distanced and quarantined.
Yeah, and that statement is the cure worse than the disease is really a concerning factor in the financial industry for sure. With that, Sean, what are the signals telling you now? Like, what do you see in the future, and what are you kind of hearing on the back end of your company?
Well, I mean, what the signals are telling us is that the moving average is coming closer to the current level of the markets in a more rapid way every single day. Like mid cap, the 200-day on mid cap is going down like 78 basis points a day. So in 20 days, that's 15%. And so, that's not normal either. It's just because of how severe things are. In large cap, it's like 30 to 40 basis points range is what the moving average is coming down. So we won't stay in T-bills forever. Sooner or later, the trend will change where the index will go back above its moving average because the moving averages are collapsing so quickly right now, and eventually we'll re-enter. But, you have to be, mindful that, bear markets come in three phases, really. There's the first phase down, and then there's always this middle phase, this little head fake on the upside that happens. And I have a couple of charts I looked at this week. This little 22%, spike up, it arrived almost exactly in the same time frame that it did the last two times we had a bear market, which is '02. Tech bubble bust in 2000 and 2002 and 2007 to 2009 with the financial crisis. What was unique about them was that there were two bear markets that sandwiched a bull market in between. And so if the pattern holds, then, we've now had that little bull market run in the middle of a bear market. And, nobody really knows what's going to happen when we all, get the numbers on earnings and what it's done to, sales for companies. And we don't know who's going to get in trouble yet financially with regard to their debt. There's all kinds of crazy stuff that could potentially happen. So at least for the trend pilots with regard to that strategy, I like to say we did exactly what we're designed to do, which is we went to the sidelines and said we're not going to go up anymore or down anymore for a while until the trend changes for us.
One of the things that's happened historically or in the late history of so many tactical managers is the whipsaw. With that violent move of the market, it's missing that downward trend, and the 200-day moving average really not catching up to the trend of the market as quickly as it needs to trigger those to go to cash, and then the reverse happening on the way back up and kind of missing some of these market opportunities. Can you talk a little bit about that and stylistically how tactical really a great solution in this still?
Yeah, the debate we've had for 10 years now on trend pilots and the moving average, because we've been doing this for 10 years. We did it with RBS before we did it on our own as an ETF company, is what's the right moving average? Is 200 the right moving average? Is 50 better than 200? Is 100 better? And, theoretically, you would think that a shorter moving average would actually get you out faster and get you back in sooner. But when you run the numbers, what you find out is that the shorter the moving average, the more moves you make. And so you exacerbate that whipsaw. What we embedded into Trend Pilot to try to mitigate some of that was the two-step move. Rather than going all the way out when the first signal hits, we go halfway out, and then we watch the direction of the moving average itself. But the 200-day moving average has been something people have been following for decade after decade after decade. Jeremy Siegel wrote about it in his book, Stocks for the Long Run. And it's not designed to be perfect. What it's designed to do is to miss as much of the downside as possible. And then at the end of that cycle, come back in at some point, not necessarily at the bottom either, and pick up. And if you can eliminate, in spite of the fact that you might get a little whipsaw from time to time, if you can eliminate some part of the catastrophic declines that we go through over time, we think you'll get a higher return than the benchmark index that you're supposed to track, with a lot less of the anxiety that goes with following the market all the way to the bottom. So we know whipsaw is a part of any tactical or any signal-based system. It's something we live with because we think over time it'll all sort itself out. We're not going to be right 100% of the time. We're not going to make, every signal and every move we make is not going to be 100% spot on, but the vast majority of them will. And over a long period of time, we believe it's a way to complement a long-only equity portfolio where you can actually produce a higher return than your benchmark and not have to live through some of those really catastrophic declines. And one last thing about the moving average strategy and Trend Pilot is that, usually when we get into the T-bill position, it's because a lot of bad stuff has happened. And when bad stuff happens in the market, people tend to just get out and then they wait forever to get back in. And the beauty of Trend Pilot is it's automatic, it's rules based. So whenever the index goes back above its moving average, we're going to go back long. We don't, the methodology is what the methodology is. And so that, to me, that may be the biggest advantage of the strategy. It's not one that seems obvious to people, but having a strategy that will unemotionally move you back into the equity markets after you've just gone through a catastrophic decline is a real value. Because left to our own devices, we're all scared to death when we get to the bottom of a bear market, and none of us want to go back in.
We're going to be right back with Sean O'Hara. We're going to talk a little bit about the tax efficiencies that Pacer brings to a lot of portfolios that people are not aware of. This is something you're not going to want to miss. It's so relevant to today's market and understanding, active trading and how that will impact your portfolio and how Pacer might be the solution for something like that. You can reach us at 855-226-8551.
Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today, we are spending some time with Sean O'Hara. He's the president of Pacer ETF Distributors and has a phenomenal story and a ton of history in several markets. We're going to have some fun jumping into, Sean's experience right away. I think there were some pieces that we left on the table. We'd love to hear about tax implications. How do taxes work? Because everything that we do from a planning perspective runs through a tax filter. So this is important, especially when looking at a tactical style of management and how to mitigate the outcomes of what trading can create and tactical management can create, especially on the non-qualified side.
Yeah, I mean, ETFs in general are far more tax efficient than mutual funds, and it's primarily due to one part of what the exemptive relief is that created exchange traded funds. Because from the SEC's perspective, an ETF is a 40 Act fund, just like a mutual fund. However, we operate under a set of exemptions. We can trade during the day. And one of those exemptions is the ability to have custom creation and redemption. So when clients buy and sell their mutual fund, they're sending a check directly to the mutual fund. And when they want to get their money back, the mutual fund company is sending the money back to the client. That's not how ETFs work. The way a client buys an ETF is through a market maker. And that market maker fills that order. And then when they want to create new shares because they've sold a bunch of our ETF, then what we ask them to do is to send us the stocks that are in the current basket for the ETF. So we don't even go out and buy the stocks. We make the market maker send them to us. And when somebody wants their money back out of an ETF, they go to a market maker and sell their shares. And the market maker in turn will come back to us and say, I need to redeem some shares today. And rather than selling the stocks inside the ETF, we'll just send the stocks to the market maker. And that's called creation and redemption. And that's how the vast majority of the tax efficiency comes inside of an ETF wrapper. So it's one thing we have available to us that a mutual fund doesn't. We don't interact directly with the public in terms of taking money in. We work with market makers, and we're just swapping securities with market makers. So therefore, we're not selling any stocks at the fund level. And that's where the tax efficiency comes from.
This is great. And for our listeners, this creation redemption strategy that we're talking about is really just the fear of people who have investments buying and selling stocks and creating lots of taxes constantly inside their portfolio and inside an ETF. Sean, this is a great reason for why Pacer is growing so rapidly, is because people who have investment dollars that want to protect the downside but don't want regular ongoing trading to impact their taxes, is a huge benefit for someone who says, "Hey, I want to ride, the S&P 500."
Well, just make it topical to today. We've just had a big correction in the market, maybe a bear market, right? And I'm sure that there are investors who are long-term investors who don't do anything. They just say, "I'm just going to ride it out," right? If you're in a mutual fund. But if you're in a mutual fund and a whole bunch of other people in that fund panic and sell, the fund manager has to sell a bunch of securities to give them their money back. And that has a negative impact on you as the shareholder of the mutual fund. You're going to wind up getting a big capital gain distribution. You don't have to worry about that with an ETF because we're not sending an individual their money back. We're working with an intermediary, a market maker, and exchanging stock shares to create and redeem shares. So there's no selling going on in the fund. So you're not negatively impacted by somebody else's behavior in an ETF.
Yeah, and I think for people who have some experience with mutual fund investing, there's that person in 2008 who lost a bunch of money in their investments and still got a 1099 from the mutual fund company, and are saying to themselves, "I didn't make any money. Why am I paying taxes on this?" And that's a real thing that you can avoid in the ETF space on the creation redemption. I'm excited about that. It's become a great play for us in a number of our managed accounts, and excited for what's gone on there. One of the things that I think I'd like to dive into is I know you have some real estate holdings inside one of your funds regarding the Pacer benchmark infrastructure strategy, the SRVR, which is highly focused on technology. Can you share a little bit about that? Because that's very much an interesting venture in today's marketplace with 5G and so forth. Could you share a little bit about that and change pace a little bit?
Sure. We're really excited about this one. SRVR is an ETF that owns publicly traded real estate, but very specific publicly traded real estate. We own data centers, fiber optic networks, and cell phone tower companies. And we think that there's a huge growth opportunity ahead for those three different sub-industries within the real estate market. Data centers are where all of the computing instances are going to take place going forward. Everybody's going to do their business in the cloud. And there are big cloud providers like Amazon and Microsoft and Google. But to connect those big, huge data centers to the end user, there are publicly traded real estate names like Equinix, for example, who's one of our holdings, who operates a publicly traded real estate firm that owns and operates and builds these data centers. And there needs to be a massive build out in the amount of computing power in the US. We're seeing this right now as we're all holed up at home. There's people starting to complain that the internet is slowing down. The reason it's slowing down is that we only have a certain amount of bandwidth, only have a certain amount of data capacity. And if we're going to have things like 5G, streaming, e-commerce, the Internet of Things, if everything we own is going to be connected to the internet, we need a lot more data centers. And then how that information will be transmitted is it will be transmitted via fiber optic networks and cell phone towers when we get to 5G. And so we think there's huge growth there. It's a way to play tech, if you will, without having to necessarily be, all in on the FANGs. So you can own the critical infrastructure is what we call it, that is going to power the internet and technology revolution that's still ahead of us.
Well, I think there's, just for radio purposes, we're not recommending SRVR as a purchase specifically, but the interesting piece about technology is that it is just a driving force in our industry right now, in our world, in our environment. I was actually driving today and noticed that they had hung wires for Comcast, which is the provider over where I'm at, right across the stoplights because there's just so much bandwidth failure. And it's amazing. They're just covering the stoplights. I could not believe it. Just a whole nother set of whatever cables, fiber optic, whatever they are. And it's just amazing at the demand for the infrastructure inside of that.
Well, something else your listeners can look for as they're driving around their town, everybody can spot a cell phone tower, right? We try to hide them around here. We put like little pine needles on them to make them try to look like pine trees here in Philadelphia. But you can spot them. But what's fascinating is that there are multiple players in this space that are taking advantage of existing buildings and infrastructure that's in place, like Lamar Advertising and Outdoor Media are two big billboard companies. We're going to be hanging cell phone tower nodes on all of those towers all across the country because there's a prohibition for how many new towers that can be built. And if you think about who has access to the critical real estate, it's the big billboard companies that you that are stretched all across these highways. And so if you start driving around your town, you'll think of me, Sean O'Hara, when you see a little, it's about a 1 foot long by about 6 inch wide, white plastic looking thing. You'll see them hanging everywhere. And that's because it's needed. We need this build out in order to be able to deliver the 5G technology that we all want.
You guys, we're going to take a quick break right here. We will be back with more. Sean O'Hara, president of Pacer ETF Distributors. We're going to be talking about what's important for you to know right now in this shift in our market. You're not going to want to go anywhere. Sit tight, have a listen. You can reach us at 855-226-8551 or info@yourmoneyontap.com.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Folks, we're talking with Sean O'Hara, president of Pacer ETF Distributors. Sean, it's a pleasure to have you with us today. And if you're just joining us, that's what's going on Money on Tap. We've been talking a lot about tactical management. We've been talking about, what is the some of the plays that are happening in infrastructure around the 5G and technology, getting caught up on that. There's a few other pieces there that I know that we want to bring to the listeners. If you could talk a little bit about like autonomous vehicles and some of the other pieces that are out there for us coming down the pipe in technology.
Well, if you think about an autonomous vehicle, what you have to understand is it's basically just a driving computer and cell phone. It's got to be connected to something that's giving it directions. It's got to be able to receive those directions, and it's got to be able to process those directions. And so when you start to think about that connectivity, and by the way, if you're going to get in an autonomous vehicle, you pretty well sure want to know that it's not going to run off the road, right? And so the reason we're not quite where we need to be yet is that we don't have 5G coast-to-coast coverage yet. There's so much information, so much data going back and forth between the satellite that's supposed to drive that car and the car itself, that we have to build out this infrastructure. And so when you start to talk about autonomous vehicles, what folks don't understand, I don't think, is that there's a huge opportunity ahead of us in publicly traded real estate, because publicly traded real estate names will be the critical infrastructure that provides the network, provides the computing power, provides the cell phone tower network that will allow our car to drive down the road as it's getting pinged 60,000 times a nanosecond from a cell phone tower that it's online with, that it's directing it down the road. And like I like to say, like when you're in your driverless car on your way home, talking to your wife on your cell phone while ordering all the Amazon groceries to be delivered at home on your iPad, and also streaming an old episode of House of Cards. None of that can happen yet until we have a massive build out in the amount of computing power we have and the amount of 5G coverage that we have. And so there's going to be a big build out to get us where we want to go. And that's only one piece of the overall story, Seth, which is kind of fascinating. I mean, the Internet of Things is as big as that. I mean, there's 7 billion devices connected to the internet today. In 5 years, it's going to be 70 billion. And so as all these things are talking to each other, they eat up data bytes, and they have to be able to communicate with each other. So if we're going to have a build out there, then we're behind and need to catch up. And, e-commerce, with what we're going through right now, it was kind of a convenience thing for some people. I think with social distancing going forward, one of the longer term trends is that that'll accelerate the e-commerce phenomenon because, who wants to go in a grocery store and then, go into the parking lot, and when you're trying to walk in the front door, they say, hold on, young man, only 25 people allowed in the store at one time. And then who wants to get scowled at somebody in the produce aisle because you're not 6 feet away from them? So if this is going to be one of the big impacts. And so these technologies are real and they're valuable to society, but we're behind the curve in terms of the build out, but that build out is accelerating.
Sean, when you talk about infrastructure and real estate, and I know you talked about the billboards and how that's going to be, but tell me a little bit more about what you think infrastructure goes beyond. I mean, are we talking about, the internet connection, to, the John Hancock building in downtown Boston that's going to be providing, or are you talking about hanging more towers on the side of those types of buildings? When you talk about real estate, be more specific if you could.
So this particular real estate play is really three things. It's fiber optic networks that are publicly traded real estate names. It's cell phone tower companies like Crown Castle and American Tower. They're the two big players. We need 20,000 more towers in order to get to where we want to go. Those are going to be the guys that build those towers because they have the technical expertise to do that. We're talking about having co-uses. So you are going to see nodes on buildings. You're going to see nodes on billboards, and you're going to see nodes on traffic signals across the country because we just need to increase the density. And then all the information flows through computers in the cloud. And the cloud is nothing more than a giant building with rack after rack after rack after rack of servers in it. And so, there's an ecosystem in the cloud. There are big, huge data centers, and then there are smaller connected. It's like a hub and a spoke if you think about it. Or it's like having a big giant center someplace and having a router some other place where we have not just one company's servers in a building, but you have multiple companies' servers co-located in these privately held in these publicly traded real estate companies like Equinix who builds them. You have other folks' servers next to their competition or next to the ones they communicate the most, so that we can cut down on latency, if you will. And so Amazon's going to continue to be a player in the cloud. There's no question. They're going to be a player in e-commerce, no question. But there are smaller players in this space that will fill in the gaps, if you will, in the ecosystem.
Folks, we are talking with Sean O'Hara, president of Pacer ETF Distributors, and we've been talking about Internet of Things. We've been talking about 5G. We've been talking about some of the infrastructure plays that are out there right now. Sean's a big part of that as well. Sean, you bring a lot of history to the table, saying you got into the industry in 85, and you are still in the industry, which is a statistic in and of itself that's not very common.
He's not saying you're old, Sean. I just think I'm offended and embarrassed.
It sounds like he's saying I'm old.
I'm just trying to tell people that people don't stick around in this industry very long. It seems like to have tenure in financial planning, financial services is a hard thing to find. But you've got family involved. You've got a whole lot of connections happening that are really unique. And I'd love to hear a little bit more about 87. You went through 87. You went through bull run of the 90s. You went through tech boom. You went through 08, 07, 08, 09. These are all big, huge pullbacks that we recognize. What are some of the similarities and what are some of the differences that you're engaged in right now? And then also, I want to hear about who is Pacer in your family, and how much fun is that to be able to work in a family business?
Yeah, well, let me start with that because that's the easiest thing to do. My partner, Joe Thompson, he and I have been working together for 35 years, which is maybe more unique than working in the same industry for 35 years. I mean, we literally have talked to each other almost every day for 35 straight years and worked sort of side by side. And when you find somebody who you're that compatible with and who you trust, and who you feel like thinks about things the same way that you do, that it creates a tremendous environment. And over the years, the one thing we've always liked is we've liked nepotism. So we like when people bring their friends into the business. And so we violate a lot of the rules that big corporate would say you can't. Like Joe's daughters work for the company, and they're my partners too. I have one son who's a wholesaler for us, and another son who's going to be joining us. Some of the key people in the organization have been together for 30 years as well. The guy that runs all of our distribution, I think I hired him in 1989, and he's still hanging around with us. So it's really rewarding to be able to have a career that, where you really like the people and you love working with them. And this current environment where we're all separated and scattered and not able to see each other is really difficult because we are like a big giant family. And that's worth a lot. It's worth an enormous amount. As far as the business goes, I remember starting in 85. I think I was all of like 22 years old at the time. And I was a wholesaler down in Texas. And I remember the old guys that were in the business forever telling me, "Oh, kid, you haven't seen anything. You didn't live through 73 and 74.
Folks, right now we are talking to Sean O'Hara, president of Pacer ETF Distributors. If this is something that you have yet to discuss or need to talk about, you can reach us at 855-226-8551.
Well, I guess I'm sad to say that I do have, I'm like the old guy there. I did live through 87. I did live through the tech bubble bust, and I did live through the financial crisis, and I'm living through this one. What they all have in common is nobody sees them coming until after they're here. I mean, if you think about the tech bubble busting, before it busted, everybody wanted to own any stock that had .com at the end of it because we thought they were going up forever. And it was only after the fact that we thought, well, maybe some of those companies should have made some money instead of worrying about users and clicks. In the financial crisis, when you had a guy who was a valet at a hotel in Florida who had 6 houses that were financed 110% loan to value, we probably should have seen that one coming too. But we didn't because we get caught up in the moment. And so what they all have in common is we never see them coming. And then the second thing that they all have in common is they all eventually pass. I was a big fan of a guy by the name of Nick Murray. Nick Murray has this saying about the stock market. He said it's 8 words. You can just use 8 words to describe it. The advance is permanent. All declines are temporary. And if you just keep that in mind as you go through these difficult times, it will pass. Nobody knows when it will, but it will eventually pass. And the values in our portfolios, if they're invested in high quality equities over time, will go back up and to higher levels than they are today. It just may take a little bit of time.
That's some great thinking there and great wisdom. I appreciate that. I do appreciate the family business thing. I grew up in a family business world myself a little bit, and that can have its ups and downs. That can have its own set of stresses. Taking the market into account is one scenario, and then having a nepotism kind of event going on in the office is complicated. But in today's day and age, in that building, it's there's probably not a lot of nepotism going on with everyone working from home. So we appreciate all the time you've taken, Sean, today, because I think there's a real value in for people to understand tactical what's going on out there and what you guys are offering. And honestly, a lot of people know about you, but not enough people know about you. And that's how we feel here at Brayshaw Financial and Money on Tap. There's a lot of opportunity inside really the ETF space in trying to get people some good exposure to the market, some downside protection. The last question I really want to ask, I know we touched on it a little bit, but tactical has had its really good years. It's had its really difficult years. And I know 18 into 19 was a really difficult year. And for people who research tactical, they can acknowledge hey, tactical had a kind of a weird scenario because of spikes up and down. And one of the questions, and I've chatted with people at Pacer about it too, and other tactical managers, with the amount of information that's really moving in our marketplace, it's almost like the amount of the market speed in which the declines and the recoils occur makes it more complicated for tactical. And I don't necessarily think that's the case entirely, but it's a challenging question I'd like to ask and just see how you would respond to that.
You can say that about a lot of things. You can say that about almost anything, really, that, when you get yourself to the point where you're saying, well, maybe this time it's different, or there's something that has been a consistent pattern for 100 years is going to change permanently forever. That worries me more than whether or not the market has changed so much that something as reliable as the 200-day moving average won't continue to add value over the next 5, 10, 15, 20 years. It might not add value today, but like I'll give you an example, like mid cap for us, the mid cap ETF, we have PTMC, it missed almost all of 2019's returns because it was out at the end of 2018. So we missed all the declines at the end of 2018, but we also missed almost all of the up move, because if you weren't invested in January and February in mid caps in 2019, then you missed most of the move, right? So we suffered, and we had guys that questioned the strategy, folks questioning the strategy. It doesn't work anymore. It's different. The market's different, yada, yada, yada. Well, right now, PTMC is down 7% for the year versus the mid cap index down, 35%. And so I just say, wait around, nothing's perfect, give it some time. And by the way, the biggest thing I could say is that you should be mixing tactical strategies. So don't do it all on one asset category. Do large cap, do mid cap, do international, because they'll all have their really great periods where they're really doing exactly what we think they're supposed to and feeling good about it. And then they'll all go through their periods where we're questioning their viability going forward. But over time, it all seems to work itself out.
And let me ask you one more question on that, because it's interesting in the allocation mechanism. I look at the demographics in America. We've got 320 million Americans. We've got close to 40 million of them retired. There's another 80 million people going to retire who control most of the wealth in this country. And, one of the concerns and one of the things we talk about is, as that aging demographic starts moving towards retirement, the natural inclination to reduce risk in their portfolio, maybe terminate, some of their small cap holdings, just reducing or eliminating or reducing their mid cap holdings and shifting to large cap. Do you have any thoughts around that kind of thinking and potentially how we might see a pullback in the higher risk general categories, irrelevant of their success as businesses and quality companies and so forth, but just a lack of interest as people are trying to create income?
Income's a huge problem, right? There's no yield for these folks. So their traditional approach to asset allocation, where we would have half our money in bonds, and those bonds would kick off a decent return, and they'd be a cushion against the declines. We're going to struggle trying to find solutions for folks that are looking for that part of their portfolio today. We're being pushed towards riskier and riskier assets, which is why we designed the high yield trend pilot story, because we want to get the higher yield, but we just don't want to own it all the time. I think theoretically, most people would agree with you with regard to, as people get older, they like to take less and less risk. But these folks today are living longer than ever. We got some of the most active, healthy retirees in the history of the planet. Mm-hmm. And if you're a healthy, active retiree, your biggest concern isn't going to be, what happens if I die in 5 years? Your biggest concern should be, what happens if I'm still playing 18 holes of golf every day when I'm 90? How do I keep living the life I'm going to live? And so I don't think people necessarily should think differently about retirement than they do about saving for retirement. It's a long time, and it's going to be longer and longer and longer. And the old approach to it would be, somebody retired at age 65 and they were dead by the time they were 70 or 71. Anybody can fund a 6-year retirement. It's not very hard. But what about funding a 30 or 35 or 40-year retirement where somebody's going to be active nearly the entire time? And so I think we need to rethink retirement as it relates to investors as well, and get them more focused on keeping their portfolio growing and staying ahead of inflation.
Folks, you have been listening to Sean O'Hara, president of Pacer ETF Distributors. Sean, it has been a lot of fun having you on with us today. We've learned a lot, and we'd love to have you come back and join us again and help keep us up to date on all the great things happening with you and Pacer. Absolutely. Thanks, guys, so much for giving me this opportunity. And I don't know if I'm allowed to say this or not, but I know you guys are users of our products, and so we deeply appreciate that as well. Yes, yeah, absolutely. Thank you, Sean. We appreciate your time. We do appreciate everything. Thanks for joining us today. You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Also, we're in a podcast. You can find us at any of the podcast venues out there. We appreciate the likes and the listens. We're also at Facebook at /3D Investing and Twitter at BFG_LLC. We appreciate you joining us here today, and we hope you make it a great day and a great life. Thanks for joining us with Money on Tap.
On this Cliff Notes edition of Money on Tap, Ben and Seth talk about HSAs.
This could be the most important retirement savings vehicle for 2020. Okay. That's the name of the title of the article there. Kevin Sweeney and Scott Benjamin did a great job here, just basically telling us this is one of those opportunities that if you're looking to the future and if you actually have health insurance, right, this is something you can use. It's a triple threat for financial planning. And so many people that have been doing financial planning work come in and don't even have this as on their radar as one of the things that they could be doing or taking advantage of.
The HSA plan, an option, that S stands for savings, health savings account. So we've gone from debt to savings here, but this is the only investment that you can put money away before tax and take it out without tax on health.
And accumulate without tax.
Yeah. I mean, it is the best tax savings vehicle there is. And
Hands down.
Yeah, and it's a great opportunity to use, save up for all your medical expenses, maybe even long-term care in the future. I mean, all of these things. I mean, starting today, you don't even have to buy long-term care insurance. If you just put some money in there, you don't have a major health event that wipes it out.
Right.
But this is a huge opportunity for people of all ages, in all demographics, in all situations.
Even if you're in a place where, gosh darn it, I haven't even opened up an HSA, but I got a critical illness or something like that I'm needing some funding for. There is a way, it's called a backdoor contribution or kind of a backdoor conversion for you to take IRA monies. And it's a once in a lifetime opportunity for you to take IRA monies and put those into the HSA. So that's one way that you can go ahead and fund that or get that funding now, even if it's just a pass through for you to take care of some current medical expenses that are happening, because one of the things you have to have in the HSA world to qualify is a high deductible plan. And most people don't even realize that they already qualify and are already in a high deductible scenario. And this can even just be a pass through for you currently to take money off the table that you're taxable on this year, pay the medical expenses this year. That's tax free. At some point, we just recommend taking a look at using it as a savings vehicle. And nationwide, I think there's like $26 billion in HSAs. 16 of those, I think, are invested now. So that's one of the other sides of these is that you can invest in your HSAs. It's not just a low savings rate type of a vehicle for you.
Yeah, if you have questions on that, you can reach us at 855-226-8551. That's 855-226-8551. A lot of people are struggling with stuff like this. And this is an area where there's a couple of backdoors to try to minimize your out-of-pocket and maximize the amount of money you can use towards your health coverage. So,
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.